Okay. So let's launch this chapter here. And usually when I start, I'm going to go through the summary review on this one. This one just talks about completing the application process. So there are quite a few questions that come on this chapter here. So again, I'm going to head to the summary recap. And I will go through that. Okay, so the first thing to understand about insurance, life insurance is about two main things. But the first big thing about life insurance is that it's used to create an estate. Life insurance is used to create an estate. That's the first big thing. The second thing is that life insurance is used to transfer risk. Insurance in general is used to transfer risk from one person to another, from the person who is going to experience a potential loss to the insurer. So if you hear them use the term indemnity, indemnity just means to protect. Indemnity just means to protect. It's based again on the law of large numbers, which just means protecting or spreading risk by having a lot of people pool their risk together. You hear a lot, they'll talk about the principle of insurable interest. Insurable interest. Insurable interest is something that must exist at the time of the application. The time of the application. And what is insurable interest? Insurable interest is defined as those familial relations, those familiar relationships or relations between the owner of a policy and the insured. So remember, insurable risk exists between the owner of a policy and the insured. And usually the owner is also the payer. Doesn't necessarily need to be, but usually the owner is the payer. Insurable risk just says there's a legal relationship that must exist between the owner and the insured, so that anybody cannot just insure anybody. You know, you cannot drive downtown, go under the bridge, see a bunch of sick people, homeless people, and you think, these people look like they're going to die soon. Let me take them and go insure them so that when they die, I can collect some money. There's no insurable risk between you and them. There's no familial relations. Examples of insurable interest include between family members. Family members, like a father and a son, a father and a daughter, a parent and a child, between spouses, between siblings. Insurable risk exists between siblings. So between family members, insurable risk will exist. Between a parent and a grandchild, or a grandparent can insure a grandchild, and a grandchild can insure a grandparent. There's insurable risk. Insurable risk, another example of it is between a creditor and a debtor. So if you go apply for a loan at the bank, you take a loan for $1 million, the bank says, hey, you can die at any time. I want to make sure that I'm able to recoup my money if you're not living, if you cannot pay. So they can take an insurance policy on you. So there's insurable risk exists between the lender and the debtor, between the lender and the borrower. They will try to trick you in the exam by giving examples of insurable risk, and you will see them twist it around and put insurable risk as existing as the borrower or the debtor having an insurable interest in the creditor or the lender. No, don't fall for it. It's the reverse. It's the creditor and the lender that has an insurable interest in the debtor or the borrower. Insurable risk also exists between, say, an employer and the employees. The employer has an insurable risk in his employees. Insurable risk also exists between business partners. For example, we have 5 partners that exist as part of a partnership or an LLC. They can cross-insure each other because somebody might have some specific skill that makes that partnership work. If that person passes away or dies, then it becomes maybe more difficult for them to run that business. They might have gone and taken a loan, counting on the skills of that partner. But if that partner passes away, that business might might get into jeopardy, or the loan they took might be jeopardized. So those partners can cross-insure each other so that if one passes away, they can collect. Also, there might be an extent that if one becomes disabled or passes away, they might want to buy out the share of that partner, and if the business does not have money to do it, they might get into legal wranglings on how to dissolve the corporation. So usually partners will cross-insure each other, and the company in this case is going to become the owner of the policy, so that if something happens to one and he passes away, they can use the money from the insurance payment to buy out the family. So you'll also see the concept of disability insurance. Disability insurance. Usually they might insure the partner so that if one becomes disabled, at least they can go through that period of adjustment by using the payment from that disability to help manage the overhead expenses of the business while it adjusts. So remember, insurable interest has to exist between the owner of the policy and the insured. Insurance contracts. Insurance contracts, just like a lot of financial instruments, remember, are about 5 things. In law, they're about 5 things, or they're about the insurance policies and financial instruments are about contracts. And there are 5 elements of a contract. There are 5 elements of a contract which you should know. This book lists 4. It talks about agreement as 1, but agreement is actually 2 elements. Offer and acceptance form the agreement. So those are 2 elements of a contract. So the 5 elements of a contract are offer, acceptance, consideration, competent parties, legal purpose. Offer, acceptance, consideration, competent parties, legal purpose. So these 5 elements must exist. Remember in the exam that for a contract to be binding, there has to be consideration. For a contract to be binding, there has to be consideration. You go to a parking lot, you tell to a car lot where they are selling a lot of cars. You see this red hot Lamborghini and you say, hey, I love that Lamborghini. I want to buy it. They make you an offer. You say, pay 80,000, you buy it. You say, I agree. Is there a contract? No, there isn't. Is there an agreement? Yeah, there's an agreement, but that agreement doesn't mean anything in the eyes of the law. There's just an agreement, there's no contract. Why? Because nothing has been given of material substance to bind the contract. Nothing has been given of material substance to bind the contract. If you leave that day and you say, hey, I'm going to come back tomorrow and get that car for that 80,000. Say, oh, okay, we'll see you tomorrow. And you leave and somebody else comes and offers maybe 85,000 or 90,000 for that Lamborghini and they sell it. Do you have any recourse? Can you sue them? No. Why? You did not give anything of substance to bind the contract. How about if you say, okay, tomorrow I'm going to be back. I'm going to put 2,500 as down payment and I'm going to come complete it. Is there a contract now? Absolutely. Why? Because something of material substance has been given to bind the contract. In insurance, what is consideration? What is consideration? Consideration is the premium you pay to bind the contract. Once you pay that premium, there's a contract. Once you pay that premium, there's a contract. And when you apply for a policy and you pay the contract, when you apply for a policy and you submit premium payment with the application, there's a contract. You are covered. From that day, you are covered. You have what we call provisional coverage. Provisional coverage. Unless, again, they give you what they call a conditional receipt. Remember that you will see that in the exam, 100%. If they give you a conditional receipt, it means they are making the activation of that policy based on a certain condition that has to be fulfilled. Conditional receipt. What is an example of such a condition that has to be fulfilled? They might say, when you go do a medical test and we are sure that there's nothing wrong with you, then your contract becomes effective. Always remember in the exam that if they give you a conditional receipt, that policy becomes effective on the day you do those tests. Even if you go do those tests and the results do not come out until 5 days later, but it's the day you do that test that contract becomes effective. So you'll see that in the exam about conditional receipt. All right. And what happens if you issue a conditional receipt, you go do those tests, they have not issued that policy and something happens to you, you experience a loss or you die before they issued that policy. Do you have coverage? Certainly you do. Why? Because that condition had been fulfilled. Offer, acceptance, consideration. Then you have legal purpose. You know, an insurance contract has to be formed based on a legal foundation. You cannot, you know, go insure somebody and then go pay somebody to come whack them off for you to collect the money. That there's no legal purpose there. So you're gonna, the insurance company is gonna deny to pay. What are other examples of consideration? Consideration is it's not just the premium you pay. Consideration in a policy is also seen as the representations you make on an application. That is also considered consideration. How tall are you? How much do you weigh? You know, what's your income? Where do you work? What's the name of your doctor? All of that information that they will seek on an application. That's also considered consideration. Remember also for the purpose of the exam that an insurance contract is a bilateral contract. A bilateral contract. What does it mean by a bilateral contract? It means there's consideration given on both sides. And a bilateral contract is one in which promises are made on both sides. Remember, the opposite of a bilateral contract is a unilateral contract. A unilateral contract is one in which promise is made only from one side and the other side binds the contract through performance. In bilateral contract, in insurance policies, which is bilateral, you promise to pay your premiums, you submit those representations on an application. So those two things are the consideration you give. What is the consideration on the part of the insurance company? What is their consideration? They promise to pay when there's a loss. They promise to pay when there's a loss. Okay. Remember, there are different types of contracts. Insurance contracts are always called contracts of adhesion. Contracts of adhesion. One party prepares the contract, the other person accepts it as it is. When they approve your policy or when they say your policy has been approved, you accept it by making a payment and you don't haggle with the terms. You don't read and say, hey, by the way, take out point number 5, I don't like it, or take out this fine print, or it doesn't work that way. So that's why they call them adhesive contracts. Contracts that are made on a take it or leave it basis. Insurance contracts are also called aleatory contracts. Aleatory contracts. Aleatory just means there's an unequal exchange of values. in that contract on equal exchange of values. You might have a policy where you're paying $300 a month. That policy has a face value of $750,000. You might pay only for 3-4 months. Something happens to you, there's a loss. $750,000 has to be paid to your beneficiary. Is that equal? Is that even? No. It's an unequal exchange of values. That's why they call it an aleatory contract. An aleatory contract. You see the term they're conditional? That the contract is conditional. Conditional just means bilateral. Just another word for bilateral. Promises are made from both sides. And then you see the word unilateral. Only one of the parties to the contract is legally bound to do anything. I always give you the example of a lady who gets up in the morning, sees an advertisement in the newspaper that says, Dealers is offering $5,000 worth Gucci bags for just $50. $5,000 Gucci bags for just $50. You get ready, throw your gown on, get in your car, your tires are screeching on the driveway, you're running. And again, by the way, add in that thing that you read in the paper that they are offering Gucci bags, $5,000 worth of Gucci bags for $50 for the first 25 people who show up. First 25 people to show up. You throw your dress, your tires are screeching, you run to dealers, you're number 3 on the line. You're like, yes, this is my day. I'm going to get me this Gucci bag. You get there, they come back, the dealers opens the door, they hand it back to number 1, take the $50, pay the taxes. Number 2, $50. And then they say, oops, we had just 2. The 25 people on that line, you're number 3. They say, oops, we're sorry. Today is not your day. We ran out. That's a unilateral contract. Why? Because only one person made a promise. Did you promise to be there to collect that back of $50? No. Who made the promise? Dealers. For the first 25 people who show up, we will sell a $5,000 bag, Gucci bag for $50. If they get to number 3 and they don't have that bag, can you sue dealers? Absolutely. And you'll recover in court because you fulfilled your end of the contract through performance, through being there. What is another example of a unilateral contract? You tell a guy who takes care of loans that if you show up next week and you mow my lawn and you trim that tree, I'll pay you $800. If you show up and you mow that lawn and you trim that tree, I'll pay you $800. Have you made a promise to the guy? Yes, you have. Has the guy made any promise to you that they're going to show up? No. That's a unilateral contract. If he shows up, mows your lawn, trims that tree, and you say, oh, by the way, I changed my mind. I really didn't want you to come. Psych, you're going to have to pay. You'll be held responsible in the court of law. It's a unilateral contract. You made a promise. They had to bind you to that promise only through performance. Through performance. All right. Process of issuing a life insurance policy. When you submit the application, it goes through underwriting. While you go to the client's house and you're taking all of that information for the policy, there's something they call the agent's report. The agent's report is a report that is based on the observations you see while you're in that house, while you're talking to that client. What is the weight-height ratio of that client? Does that client live alone? All of those things that you can observe and put in that report. Those are called the agent's report. Agent's report. Companies will use multiple sources to arrive at a conclusion about a policy. One of those, remember for the exam, the primary source that the company uses to make a decision is the application, is that application you put in. They also have what they call consumer reports. They can get consumer reports to make a decision. They can run your credit report. You can run your consumer report. You can get information from what they call the MIB, the Managed The Medical Information Bureau. What is the MIB? What is the Medical Information Bureau? It's a database that is operated by the insurance companies. And every time there's information pertaining to people who apply for policies, that information goes into the Medical Information Bureau. And the companies can always query it. You might have gone and applied for a policy for Nationwide, and now you're applying at Prudential. Guess what? They're just going to go in that database, whatever Nationwide has. They're going to use it as part of the information to arrive at a decision of if they're going to approve you or not. Remember the risk classes, standard, substandard, preferred. Preferred is the best, and sometimes some companies are going to have 3 subclasses of the preferred. They're going to have preferred elite, preferred plus, and preferred. So those are all very good standards. Remember, the higher the standard, which means the higher your rating, the lower can be your premium. The higher your rating, the lower can be your premium. The lower your rating, the higher can be your premium. For example, if they rate you as tobacco, which means you're a smoker, which is one of the lower ratings, your premium might be higher. Okay. Remember, one of the key things they use for determining your premium on a policy, one of the key things they use is your attained age. Your attained age. Remember, mode refers to how frequently you pay your premium mode. So do you pay your premium every month? Is it monthly? Is it quarterly? Is it biannually, which means every 6 months, or is it annually? For the exam, remember that annually, if you pay your premiums annually, it can be cheaper than if you pay it monthly. You run through something in some of the chapters down the line where it's shown that if you're paying your premiums monthly, the grace period is about, for some states it's 14 days, for some states it's 10 days, depending on your state. But for most states, if you're paying your premium monthly, the grace period is 14 days. If you're making your premiums weekly, the grace period is 7 days. And if you're making your premiums yearly, your grace period is 31 days. Sometimes you see they'll throw 30, 31 days. Either of them is correct. What is the grace period? The grace period is the period which, when you miss your premium, after you miss your premium, the grace period is the period where your policy is still going to stay active. After the grace period is done, your policy is done. Unless it was a universal life policy and they have what we call automatic premium loan, where when you're past your grace period, they'll take money out of your premiums, out of your policy value, and pay your policy. Again, for universal policies, you pay more. Your policy bills cash. Your policy bills both cash value and policy value. If you miss your payment and it's past the grace period, they'll take it out of your policy value and pay your policy so that your policy should not lapse. Remember, when your policy is approved and the agent delivers it, there's always something you sign called a statement of good health. A statement of good health. And a statement of good health just says, nothing has changed in your health since you submitted the application. Nothing has changed. Usually, if you submitted the policy with a premium, then it was already active. So when they deliver the policy, there will be no need for you to sign a statement of good health. Other documents that can be signed at policy delivery, in fact, there are 4 documents that can be signed. There's policy delivery receipt to show that they've delivered the policy to you. The statement of good health, again, just to show that nothing has changed since you applied. There's amendment statement. If some conditions or some attributes of the policy change while it was going through underwriting, then you have to sign an amendment statement. Then also you sign what they call the numeric summary. Sometimes the amendment statement is also called the amendment statement of good health. Again, you also sign the numeric summary, and the numeric summary just means you agree with the illustration. Now, if the illustration does not change while you're going through underwriting, if the illustration they gave you of the policy doesn't change, then you don't need to sign an amendment statement because nothing changed. Remember about the Fair Credit Reporting Act. It protects consumers against circulation of inaccurate or obsolete information. The Fair Credit Act protects consumers against the circulation of inaccurate or obsolete information. All right. Let's see if we can get into some questions here. Let's see if you allow us get into some questions. Is he gonna let us? Let's get into some questions here. Let me try to see if I can navigate my way to the questions. All right, let's get to the questions. Chapter quiz. Okay. So we're gonna take turns having you guys read the questions so that we can all participate. Oluwatosin, you want to read this one?
Okay. Which of the following protect consumers against the circulation of incorrect or obsolete personal or financial information?
Okay.
The Guarantee Association, Unfair Trade Practices Law, Consumer Privacy Act, the Fair Credit Reporting Act.
Okay.
The Fair Credit Reporting Act.
Correct. Correct. Inaccurate or obsolete personal or financial information. Yeah. When you hear that, they're talking about the Fair Credit Reporting Act. Very true. So, you want to read that explanation?
The purpose of the Fair Credit Reporting Act is to protect consumers against the circulation of inaccurate or obsolete information and to ensure that consumer reporting agencies are fair and equitable in their treatment of consumers.
Very true. Very true. By the way, we had 3 people pass their exams on Friday.
Good. Glory. Glory.
3 people pass. We had
Good.
Tina pass, we had Geraldine pass, and then we had another gentleman called Gerald who passed. So,
oh, great. Yeah, we are next.
Sure, you guys
yeah.
are.
Yeah.
Let's go to the next question here. Yvette, are you there? And if you are there, can you read this one?
Yes. What is the definition of a unilateral contract?
Okay.
A, 2 or more parties go into contract understanding there may be an unequal exchange of value. B, one-sided. Only one party makes an enforceable promise. C, one author The company wrote the contract. The insured must accept it as written. C, if one party makes a condition, the other party can counter offer.
B, one-sided, only one party
One
makes
party makes an enforceable promise.
Correct. Just like the example of dealers we gave. Let's try to understand some things here. How about C? It says one author, the company wrote the contract, the insured must accept it as written.
That's adhesion.
Yes, adhesive contracts. Yes, contracts of adhesion. Very true. And then A says two or more parties go into a contract, understanding that there may be an unequal exchange of values. What are we talking about there?
Aleatory.
Aleatory. That's correct.
Okay.
So the answer is B. Let's see if we're right. We submit. Yvette, do you want to read the explanation?
An insurance contract is unilateral in that only one of the parties to the contract is legally bound to do anything.
Okay. Let's go to the next one. Miss Lola, are you there? And if you are, can you read this one? Lola, are you there? All right. Miss Karen, are you there? Can you read this one? Okay.
Oh, is it me?
Yes.
Contracts that are prepared by one party and submitted to the other party on a take it or leave it basis are classified as A, aleatory contracts, B, contracts of adhesion, C, unilateral contracts, D, binding contracts.
Okay. Are we talking about them?
Contract of adhesion.
Correct.
B.
Contracts of
adhesion. Yeah.
There we go. Miss Karen, can you read the explanation below?
Insurance policies are written by the insurer and submitted to the insured on a take it or leave it basis. The insured does not have any input into the contract but simply adheres to the contract.
Okay. Very true. Very true. All right. Number 4. Oluwatosin, you want to read this one?
Okay, sure. Under the Fair Credit Reporting Act, individuals rejected for insurance due to information contained in a consumer report must be advised that a copy of the report is available to anyone who requests it, are entitled to obtain a copy of the report from the party who ordered it, may sue the reporting agency in order to get inaccurate data corrected. D, must be informed of the source of the report.
Okay. All right. So again, a lot of questions before you answer them in the exam, always go through what we call the process of elimination.
Okay.
So it's always good to eliminate the two that are not very likely. So it's always good to eliminate those, and then it gives you a fair chance of at the right answer. So of these answers here, which ones do we eliminate first?
G.
D. Okay. I'll hold on to D first.
Yes, I thought it would go.
Must be informed. Okay. Ensure the reporting and trigger in. Let's see.
Let's start with A. A says must advise that a copy of the report is available to anyone who requests it. Does that sound true?
No.
No.
Correct. That doesn't sound like what might be the right answer here. So,
And C should go to, I think, C too.
yes. Let's look at, yeah, see also, look, whenever you see an answer that is very extreme,
Yes.
yeah, be suspect of it, eliminate it. Must be, there are two words in A, must be advised, that's too extreme. And the last part of the answer says to anyone, must be and to anyone, we kick it out. C says, may sue the reporting agency in order to get inaccurate data corrected. Sue, you jump from seeing a mistake to suing. That's too extreme. So we eliminate those two. So we are now with B and D. B says, are entitled to obtain a copy of the report from the party who ordered it. D says, must be informed of the source of the report. Now let's look at B. B says, are entitled to obtain a copy of the report from the party who ordered it. Generally, when it comes to credit reports, it is not the party who ordered the report that you get a copy from.
Okay.
It's the party who furnished the report.
Okay.
So you obtain a report like from a credit agency, from Experian, from any of those credit agencies. So it's the party who supplied the report that you get a copy of. You just need to make a request, and the credit company or the credit rating company that issued or furnished that report will send you a copy.
So D is likely. So
that leaves us with, so must be informed of the source of the report. It's a legal requirement that they must inform you of the source of that report. And that's correct. Yeah. You want to read the explanation?
Okay, so under the Fair Credit Reporting Act, if an insurance policy is declined or modified because of information contained in a consumer report, the consumer must be advised and provided with the name and address of the reporting agency.
Correct. Correct. That's very true. Very true. All right. Let's go to the next one. 5 of 15. Yvette, can you read this one?
Under the policy delivery, the producer may be required to obtain any of the following except A, payment of premium, B, signed waiver of premium, C, delivery receipt, D, statement of good health.
Is it signed waiver of premium?
Yeah, so upon policy delivery, the producer may be required to obtain any of the following except.
So waiver of premium.
They mean 3 are right, 1 is wrong. 3 are right, 1 is wrong.
1 is wrong.
So payment of premium, yes. If the premium has not been paid, they will receive.
Yeah.
Let's go to D, statement of good health.
Yes.
Okay.
Delivery receipt.
Delivery receipt, yes.
Signed waiver of premium.
Signed waiver of premium. The right answer. Why would you be why would you have to waive the premium? Then they will not deliver that policy. So that's the answer. And that's correct. Yvette, you want to read the explanation?
Yeah. The policy does not go into effect until the premium has been collected. If the premium was not collected at the time of the application, the producer may also be required to get a statement of good health from the applicant at the time of policy delivery. Waiver of premium is a rider that can be added to a life insurance policy and not something to be obtained from the applicant.
Okay. Very true. Very true. Miss Karen, you want to read this one? Okay. If Miss Karen is not there, Mr. Oluwatosin, you want to read this one?
Okay, sir. Under the Fair Credit Reporting Act, if a consumer challenges the accuracy of the information contained in the consumer or investigative report, the reporting agency must change the report, send an actual certified copy of the entire report to the consumer, respond to the consumer's complaint, defend the report if the agency feels it is accurate.
Yeah.
And send an actual certified copy of the entire report to the consumer.
Okay. That's another fair credit reporting. If the consumer challenges the accuracy of the information contained in a consumer or investigative report, the reporting agency must. And which answer did you say was the answer, Mr. Oluwatosin?
Be sending an actual certified copy of the entire report to the consumer.
Okay. So you've already eliminated A that says change the report.
Yes, it can be changed.
You eliminate D also that says defend the report if the agency feels it is inaccurate. So you eliminate that.
Yes.
So we are left now between B and C.
Respond to the consumer's complaint.
Do you find something extreme in B? Is there anything that you find extreme in B? Look at it closely.
An actual certified copy.
Correct.
And the entire report.
Yes.
Okay. Get it.
That sounds very extreme.
Yeah.
That leaves us with which answer?
C, okay. Respond to the consumer's complaints.
Correct.
Yeah.
Correct. And that's correct. You want to read the explanation below?
Yes, sir. The consumer has the right to request the information on the report. The reasons for turn down and adverse underwriting decisions. The reporting agency is required to respond to the consumer's complaint and, if necessary, to reinvestigate the report. Oh.
All right.
Yeah. Okay.
All right. Miss Karen, if you're there, can you read number 7? If not, Yvette, can you read it?
Insurance policies are not drawn up through negotiations, and an insured has little to say about its provisions. What contract characteristic does this describe?
Yeah.
A, personal. B, adhesion. C, unilateral. D, conditional.
What is our answer?
B.
Adhesion. Not to negotiations. So adhesion.
Correct.
Leave it or take it.
Yep. Yvette, you want to read that explanation?
A contract of adhesion is prepared by only the insurer. The insurer's only the insurance only option is to accept or reject the policy as it is written.
Okay. Very true.
Yeah.
Very true. All right, let's go to number 8 of 15. Oluwatosin, you want to read this one?
Okay, sir. In terms of parties to a contract, which of the following does not describe a competent party? The person must be at least completed secondary school and secondary education. The person must be mentally competent to understand the contract. The person must not be under the influence of a drug. of drugs or alcohol. The person must be of legal age.
Okay. So which of those does not seem like a condition that describes a competent party? Which of those is not relevant to getting into an insurance contract?
The person must have the person must have at least completed secondary education. It does not have anything to do with competence.
Yeah, A.
In terms of relevance, that is not relevant. So the person must have at least completed secondary education. Not relevant. So
the parties to a contract must be capable of entering into a contract in the eyes of the law. Generally, this requires that both parties be of legal age, mentally competent to understand the contract, and not under the influence of drugs or alcohol.
All right. 9 of 15.
Which
of
the following statements is not true concerning insurable interest as it applies to life insurance? A married person has an insurable interest in their spouse. B, a debtor has an insurable interest in the life of a lender. C, business partners have an insurable interest in each other. D, an individual has an insurable interest in their own life.
I think B, debtor has an insurable interest. It should be a lender having an insurable interest in the debtor.
Very true. Very true.
Not true. Yeah.
Very true. You're right. So a debtor has an insurable interest in the life of the lender. What is the proper format there?
Should be reversed. The lender has an insurable interest in the life of the debtor.
Okay.
The creditor.
All right. Very true. Very true. Very true. Yeah. So let's see if we're right. And that's correct. You want to read the explanation below?
Lender has an insurable interest in the life of a debtor, but only to the extent of the debt. The debtor does not have an insurable interest in the life of the lender. Okay.
Very true. All right. So, Mr. Oluwatosin, you want to read this one? By the way, welcome to class, Florence, and welcome, Dr. Omotola. Welcome to class.
Thank you.
In classifying a risk, the Home Office Underwriting Department will look at all the following except applicants' past income, applicants' past medical history, applicant present occupation, applicant's present physical condition.
Okay.
Income, applicant's past income.
Past income.
Yeah. They will look at the medical history, yes, the occupation, current occupation, the physical condition, not income, past income.
All right. You think the applicant's past income is relevant? All right. Let's see if we are correct. And that's very correct. Yes. Explanation.
In classifying a risk, the Home Office Underwriting Department will look at the applicant's past medical history, present physical condition, occupation, habits, and morals.
Correct. Correct. All right. Let's 11 of 15 here. Florence, I know you just joined. Are you able to read?
Yes.
All right. Go ahead and read this one.
Which of the following is a risk classification used by underwriters for life insurance? A, excellent. B, standard. C, normal. D, 4.
B standard.
Okay.
Risk.
So Mr. Oluwato,
Risk, I think is
Mr.
D.
Mr. Oluwatosin thinks it's B, standard.
I know, yeah. What is standard?
Yeah.
That's a preferred
First standard, substandard.
substandard. Yeah, so
Yes, sir.
Standard B.
standard is the right answer, just like Mr.
Yeah. B. Substandard.
Correct.
Yeah.
Yes, you want to read the explanation?
The 3 rating classifications that denote the risk level of insured are standard, substandard, and preferred. This classification system helps insurer to decide if an insured should pay higher premium.
Right. Correct. So Yvette, you want to read this one?
If an insurer requires a medical examination of an applicant in connection with the application for life insurance, who is responsible for paying the cost of the examination? A, the examiner. B, the applicant. C, the insurer. And D, the cost of the examination will be waived. The applicant.
The applicant.
If an insurer requires a medical, is the applicant
Yeah, I second.
Even-
responsible?
Examination of an applicant. You think the applicant will pay the cost?
I don't think so. I
The
think
insurer.
it's the insurer.
Yes, you guys are right.
The insurer.
Insurer is the one who is going to pay. But in a case, I'm going to give you guys a little caveat, a little exception here. If the insurer pays for the examination, usually they'll direct the applicant to somebody of theirs who does that test. Maybe it's a nurse that is going to come to your home, they do that test, they submit the results. If the client feels that the report is not right, for example, if they come test your blood, look at your A1C, and your A1C, they say your A1C is 7.7. When you know that your A1C, again, A1C measures your blood sugar level. When you know that your A1C is maybe 5.8, you're like, what? How did you guys get 7.7? You can go do another test from an accredible health facility or medical doctor or hospital at your own cost now and submit it to the insurance company. So if you go do a test and you come up with results that disprove theirs, they will accept it, but it will be at your own cost. So.
Okay.
Yeah. Question number 13 here. Oluwatosin, you want to read this one?
All of the following are duties and responsibilities of producers at the time of application, except explain the nature and type of any receipt the producer is giving to the applicant. Check to make sure that there are no unanswered questions on the application. Change an incorrect statement on the application by personally initialing next to the corrected statement. Probe beyond the stated questions if the producer feels the applicant is misrepresenting or concealing information.
Correct.
It's C, change an incorrect statement on the application by personally initialing next to the corrected statement. Yes.
Okay. If there's an
incorrect statement,
it is corrected. Who is supposed to initial that correction?
The applicant.
The applicant.
Supposed to be the applicant.
Correct. Not the producer.
The producer.
Yeah. Let's submit. And that's correct. You want to read that explanation, Oluwatosin?
Any changes to information on an application must be initiated by the applicant.
Okay. Number 14 here. Florence, you want to read this one?
What is the time frame for filing relevant suspicious activity report? A, within 90 days of suspicious transaction. B, within 30 days of initial discovery. C, within 30 days of suspicion transaction. D, within 90 days of initial discovery.
Wow.
Activity report is like when you go to the bank or when you go to a financial institution, they find something suspicious about your transaction. For example, if you're somebody who every month you are depositing like 3,000 or 4,000 into that account, and they suddenly see 90,000 is deposited into that account, they will hint the compliance officer of the bank. And when they hint the compliance officer of the bank, the process is you hint that officer of, you file a complaint because there's a suspicious activity. Then the compliance officer has to do an investigation. So you file a complaint, they do an investigation, and if they find it credible, then they'll produce a suspicious activity report. So, so there has to be initial discovery.
Initial discovery. I think it's B.
Yeah.
30 days.
So they say within 30 days of discovery, within 90
discovery.
suspicious transaction. So what is the time frame of filing suspicious activity reports? Well,
within 30 days of initial discovery.
Yes, but I might have been a little.
Oh, it's
30 days of initial suspicious transaction.
After you notice the suspicious activity, then you have to file a suspicious
transaction.
So I would say within what answer do you guys think it is?
I don't know whether it's between 90 or
30 or 90.
I think it's 30 days.
30 days.
Yes.
It's 30 days.
Then that would be within 30 days of suspicious transaction.
Correct.
Transaction C.
Transaction C.
That's what I'm leaning towards as well. Let's see if we are right.
Oh,
within 30 days
we are wrong. Initial discovery.
Yes.
Initial, that's B.
Okay, so I got a little mixed up here, and again, when you've noticed the suspicious transaction, you file a complaint with the compliance officer. The compliance officer does an investigation, and then if he finds it credible, he files that report with FinCEN. FinCEN is an organization within the U.S. Department of Treasury. You file that report with the U.S. Department of Treasury and this is something that came out of the 2001 Patriot Act, where they used a lot of the banking system to wire money or to move money that they used for 9/11. So after that, they came up with a whole body of law to monitor transactions, especially transactions that throw a red flag. So you file a complaint with the compliance officer, and every financial institution must have a compliance officer. And if that compliance officer does the investigation and there's discovery, then they have to file with the FinCEN, which is with the U.S. Department of Treasury. So, but we've learned. All right, let's go to number 15 here. Florence, you want to read this one?
All of the following would be considered an insurance transaction except A, advising a policyholder regarding a claim, B, soliciting a policy, C, negotiating coverage, D, obtaining an insurance license.
Okay. Which of those four is not it's not an insurance transaction?
Which of the four? Or which one?
Yeah.
You obtain an insurance license.
Insurance transaction.
Okay. So that's a very powerful instinct to key in on that. So obtaining an insurance license is not an insurance transaction because you're still trying to get the license. You haven't gotten a license, so you're an agent yet. But advising a policyholder regarding a claim, that's a transaction. Soliciting a policy transaction. Negotiating
coverage.
That's a transaction. So you're right. D is the answer.
Obtaining an insurance license.
Then we click submit. And that's our score.
Okay. Missed one.
Good job, guys. You missed one, or we missed just one. The one about filing the suspicious activity reports. So, yeah. So that's good. That's good. That's good. All right. Let's try to do one more chapter quickly. You know, let's try to do one more chapter quickly. Types of policies. Types of policies. So again, I always go to chapter recap. Let's go through the chapter recap quickly, and then we will. Oh, this chapter recap is not very short, but we will try to do the best we can do. Chapter recap. So term policies. Again, term policies are what they call pure protection. You know, the first thing to notice about term policies is they last only for a specific duration of time. Might be 10 years, 15 years, 20 years, 25 years, 30 years. The maximum a term policy will last is 30 years. After 30 years, it expires. You don't have anything anymore. The other thing to note, to observe and to recognize about term policies is that they do not accumulate cash. Term policies do not accumulate cash. They have a level premium. They have a level premium and a level death benefit. So pay attention to that. Term policies are level premium policies with level death benefits. Level premiums with level death benefits. There's something called annually renewable term, and those are term policies that renew every year. Usually, a term policy is not going to be something that renews every year. So it's something that has a term, and during the period of that term, the premium is level. But you have policies that are annually renewable term, which means the premium slightly increases each year. Because remember, the number one condition that they use for calculating your premiums are your attained age. So if a policy is an annually renewable term, means every year you're just 1 year older and your premium notches up just a little bit. Okay. Decreasing term, pay attention to this. Again, decreasing term is also called credit life. Credit life is when you go to the bank, you take a loan from the bank and the bank takes a policy on you. That policy is usually called decreasing term. Remember that with a decreasing term, it is not the premium that is decreasing, it's the face value or the death benefit. Also remember that with a decreasing term, you can only take a policy on the insured to the extent of the loan. So if the loan is $1 million, you can take a policy for $1 million. If the loan is 500,000, you can only take a policy up to 500,000. The loan cannot be $1 million and you take a $1.5 million policy on the client. Remember that with a decreasing term, as you pay down the loan with the bank or with the lender, the face value or the death benefit of the policy also goes down. And when that loan is close to being paid off, the death benefit of that policy also is close to zero. Decreasing term. Remember that term policies are usually the preferred policies for decreasing term policies or for credit life. Okay. Features of term, they might be renewable and they might be convertible. Sometimes you can convert a term policy to like a universal life policy. Remember this, you will most likely see it in the exam. A universal life policy is an annually renewable term policy with a cash account. Annually renewable term policy, cash account. The universal policy has two sides: annually renewable, cash account. The initial face value is the initial death benefit of the policy. That's the face value is the initial death benefit. The current death benefit is the initial death benefit plus the growth in cash. That investment component. People don't like to use that word investment, but that the growth of equity in that policy. Okay. Remember about whole life. Whole life is old school policy, old school universal. It's permanent protection. The premium is level. It can have cash value and living benefits, you know, and it matures at age 100. Remember that it matures at age 100, which means by age 100, if you haven't passed away, they'll still pay you the death benefit. Whole life policies. Okay. Remember that you can have a type of whole life policies called, the type of whole life policies called limited pay whole life. Limited pay whole life, which means you pay the premiums up to age 65 or for 20 years, whichever comes sooner. Up to age 65 or until 20 years, whichever comes sooner. So if you buy a limited whole life and you're 50, you're going to pay just for 15 years because you are going to be 65 and the payment stops. But that policy lasts until age 100. So again, universal life policy. Remember, it has an annually renewable term policy. It's got two options, option A and option B. Option A and option B. When they talk about option A, they are talking about what they call level. Remember, when you talk about universal life policies, option A, they are talking about level. I was hoping that I didn't have to run an illustration, but I always, when I get to this point, I like to run an illustration so that you understand it, what they are talking about, the difference between level and graded, between option A and option B. So I'm going to run a quick illustration here, just so that you can relate to what we're talking about. So let's say this client is, let's say the client is from Nebraska, okay? Client is from Nebraska. Let's call this client Moshood Abiola, one of my favorite names. Abiola. Let's say he's 35. He's male. We give him preferred elite. I really want to give Abiola some money. So again, let's leave it at graded. Let's give him a $2 million policy. $2 million policy. Target, which means they are paying the premium that is recommended to keep that policy active and build some good cash. $2 million policy here. As financial professionals, you direct where their money is invested. So we want to put 100% in the balance uncapped here. 100%. Okay. Let's go to the next one. We don't worry about income and targeting, but they can take income out of this policy at retirement. For riders, let's give them critical illness. We give them critical illness, and let's give them long-term care as riders. Let's see how we want our report to look. Let's have a picture of the beach. And let's check these 4 values here. And let's go calculate to see what the premium is for a $2 million policy for Moshood Abiola, age 35. We're very sure that Abiola will not have any problem paying this premium for a $2 million policy. 1,705 is how much it's going to cost. Like I say, I see this purely as an investment. People don't like to see it as an investment, but to me, it's an investment. So one of the best savings accounts you can have, $2 million policy. But there's the reason why I ran this illustration, and the policy when you meet a client, you can run them an illustration for 250K. It doesn't have to be 2 million. I'm just using this as an illustration. So let this premium not scare you. But when you get your license, you're going to be properly trained, you know. But one thing that I wanted to show by running this illustration, based on what we're studying, is that you see this policy has a death benefit of 2 million at the end of year 1. It starts increasing to 2,014,000. That's the graded component. Let me just, I was afraid that we're gonna time out here with the licensing, but that's okay. We'll go back in there. Okay. Let's go to the login. This thing will time out quicker than we want. We'll time out quicker than we want. Let me log in. All right. Takes us back to where we were. At least it remembered us, which is good. Remembered us. We're talking about these concepts here. Olua, are you there?
Yes, I am.
Just wanted to make sure that somebody was paying attention. If you look at here, they say option A is level, option B is graded, increasing death benefit. If you look at that illustration that we ran, see the death benefit is increasing, this is graded. It's a graded policy. Graded just means there's a good balance between increase of your death benefit and increase in your cash value. As you can see, by the time this client is 15 years, they now have $344,000. They've put 306. They have cash for 344 right here, and their death benefit is over $2.3 million. By the time they are 25, Right here, they've put in 511. They have 852,000. And their death benefit is 2.8 million. Their death benefit is increasing. All right. And they can take their cash out anytime. They can take a loan against it. All of that cool stuff. Let's go look at if we run it as option A. That is option B. We run it as option A. Option A. Let's go menu. The design here. Okay. Remember, but death benefit option graded. That was option A. If we had put it as level, level is option B. Put it as level, that's the only thing we change. We click on calculate. Again, let's go to cover page. Nothing changes. Premium is still the same. Face value is still the same. Okay. But let's scroll down to the numbers. Right here. Now, what is happening to the death benefit? Is it increasing? No. So cash value is increasing, but death benefit is not increasing. So you can take your cash while you're alive, but if you die without taking your cash, who keeps your cash? The insurance company. So we never run a policy with level. We never recommend level. We always run it with graded. Now they say graded will increase your cash a little bit more slightly than level, but it's not worth it. It's not worth it. So let's go back. I just wanted for us to understand that concept by running that so that we can see the difference. Again, that was your cash. You can take loans against it. You can make withdrawals. After you pay a policy like that for 20 years, you can stop paying. And that policy will run forever. You can stop paying and the policy will not exhaust. Again, let me just show you guys that quickly. It's good to demonstrate such a concept so that you guys know what a powerful policy you guys have, or you guys are going to be introducing people to. Let's go to menu here. Go to policy design. Change it back to graded. Let's say we want to pay for just 20 years. This client will go A1. This client is 35. So let's go A, 35 plus 20 is 55. So that they pay for those 20 years. That's the only thing we changed. Do calculate. We come here to cover page. Cover page. Scroll down. So you see we are paying you start paying, this is premiums. You start paying after 20 years. See zeros after that, zeros. You're not paying anything else, zeros. Well, when you start paying at age 55, what was your cash? 561. What's your death benefit? 2.561. Let's go 15 years later. Let's do 15 years later. You're 70. You start paying, no more premiums. What's your cash then? Over $1.2 million. What's your death benefit? Over $3.2 million. So that's the power of the universal life policy. You can pay for 20 years, stop paying, that policy will run forever. Why? Because that policy had developed cash policy value and cash value, and this will continue to fuel your policy. If you go at age 20, let me just demonstrate. I don't want this thing to time out anymore. So I'll go back in here so that it doesn't time out. I just want to show you guys something quickly. Again, just to show you guys how powerful a policy you guys are going to be educating people about. Let's go to age 20. When this policy has been in existence for 20 years, which is age 65. See, if you come here, say age 19, the cash value is 512 right here. Age 20, what's the cash value? 561. What's the difference between 561 and 512? That's about 40,000. So at this stage, your cash value is growing from 1 year to another. All right. So your cash value is growing by more than 2 times or about 3 times what it was. About 50,000, about $50,000 growth. That's how you can continue and not pay your policy, because it's growing by about 2.5 times. They will just take it out of your policy value pay, but you still continue to add equity. Because at that time, compound interest, compounding has kicked in. Your money is now growing exponentially. This is a very powerful tool. So let's go back to our notes here. Let's go back to our notes here. All right. Other types of policies, variable life, variable life. Remember, to be able to do variable life, you have to have a variable license. You have to have passed a securities license. So you need to have life and producer and also pass a securities license. Why? Because variable will involve taking people's monies and putting it in the variable sector, investing in stocks and all of that. You need a securities license. But to be able to do term with living benefits, fixed index assets, fixed assets, index universal life, whole life, you don't need a securities license. So you can do all of that. That's a whole big business that can turn you into a millionaire, and you don't need a securities license to do that. All right. Remember that with variable assets, when you put your money in the company to invest, they will put your money in a separate account. Why? Because you are choosing to own the risk of your investment. You're investing in assets that are variable, that are not guaranteed. So they will track your growth in your own separate account. But if you are invested in fixed assets and all of that, fixed assets, fixed index assets, universal life, whole life, fixed annuities, fixed index annuities, all of that, they'll put your money in the company general account, because there's a minimum that the company has guaranteed to pay you. Okay. They'll throw in something also called FINRA. FINRA is an organization that if you pass a securities license, you have to be registered in. So if you're doing variable, you need securities license and you need to be registered with FINRA. You hear the concepts of joint life and survivorship life. Joint life is when 2 people are insured under the same policy, usually husband and wife. I always say, if you have a pen, write this down, and you will not miss this in the exam. Write the fact that joint life equals to first to die. Joint life equals to first to die. So you have husband and wife on the same policy. When one person dies, they pay the death benefit. They don't pay anything when the second person dies. So joint life equals to first to die. They pay when the first person dies. Survivorship life equals to second to die. They don't pay anything when the first person dies, but when the second person dies, they will pay something. Remember that because they pay when the first person dies in joint life, the premium might be slightly higher than survivorship life. Because in survivorship life, it's going to take longer for them to pay for the loss. It's going to take longer for them to pay the death benefit. Annuities. Annuities. It's a big topic here. What is an annuity? An annuity is an account that you create. An annuity is an account that you create. You bring money from either an investment account, a brokerage account, you roll money from a 401k plan, from a retirement plan, from a 403b, from a TSP to create an annuity. And an annuity is an account that you create to prepare for retirement. It pays you money at retirement. There are very many terms relating to annuity. You always hear about the accumulation period. This is when payments are made into an annuity. It's also called the growth period. It's also called the growth period. An annuitant has an owner. That's the person who brings money to create an annuity. It has a beneficiary, and it has an annuitant. An annuitant is the person who would benefit from the annuity. So you create an annuity, and money is going to be paid to somebody after a certain duration of time. And at this point, I want to show an example of an annuity. I think I have one that was open here that I can use as an example. Yeah, right here. So this individual brings $700,000 right here, 700K, creates this annuity. Annuities sometimes will pay you a bonus. They'll pay you a bonus. And annuities will pay you a bonus. So you bring this money, you create this annuity. This individual brought 700K. They created an annuity, and they paid about 30% bonus on this. So the benefit base initially is $926,000 here. That money grows, and at the end of the 7-year period, this individual blocked this annuity for 7 years. That money has grown to over $1.3 million. This individual gets paid $69,000 every year for the rest of their life. $69,000 every year for the rest of their life. How about if they live to be, say, 84? If they live to be, let's say, 94, they would have gotten paid over $3.2 million right here. They will pay them that money every year for the rest of their life. This is called an income stream annuity. So an annuity has an annuitant. That's the person who draws money from the annuity. An annuity also has a death benefit, which means if the person dies without them having paid the money, the remainder is paid to the beneficiary. It has a cash surrender value, which means if you decide that you want to submit money and cash out your annuity, that's what they will pay you. Because you block the money for 7 years, it's supposed to stay in there and grow for 7 years. Because they also take that money and they invest it in long-term assets that they intend for that money to grow so that they can pay you an income stream. So it has a cash surrender value, a death benefit, a benefit base, and this is generally what we call an income stream annuity. So this is an example of an annuity here, and I personally wrote this one. So this is an annuity I wrote. All right. So he's got an annuitant, who is the person who will draw from the annuity. The annuitant does not necessarily have to be the owner, but usually the owner is the annuitant. So somebody creates an annuity where at retirement, they will draw money from that annuity. There's the beneficiary. Again, if that person dies without having drawn the money, they pay it to the beneficiary. We have different types of annuities. We have fixed annuities. These are annuities that will pay you a guaranteed interest rate. For example, they might say, for the 5 years or the 7 years that you're going to block this annuity, will pay you 7.25. 7.25. All right. Just give me a quick minute. Let me grab my charger. My power is running low. I don't want to lose power. So Sorry about that. When you have kids in the house, they're always coming and grabbing your power cord. So everybody has devices these days. All right. So there are different types of annuities. You have fixed annuities. Again, they guarantee you a certain minimum interest rate payment. Again, they put your money in the general account because the company has guaranteed you a certain interest rate payment. You have variable annuities. Again, remember I talked about variable annuities. They'll put your money in separate accounts because your money is going to grow in a variable capacity, So those are variable annuities. So they put your money in the variable sector. Again, you need a securities license for them to be able to do a variable annuity. And they can invest your money in stocks, bonds, mutual funds, all of those variable assets, crypto, you name it. Index annuities, again, they pay you a fixed guaranteed minimum interest rate, but you can earn higher. So so index annuities, they pay you a guaranteed interest rate, but if the market does well, they can pay you above that guarantee. That's why they call it index, because they put your money in an account and they peg it to one of the indices on Wall Street, NASDAQ, Dow Jones, Global Account, Standard & Poor's, any of those, balance on cap account. And as that account grows, they peg that growth to that fund, to that index fund. So if that account grows by 10%, or if that index on Wall Street grows by 10%, say the S&P did a 4% growth and your account was pegged to the S&P 500, you grow by that. Some accounts will grow above the cap. A lot of those fixed index accounts will have a cap. The cap might be 15% growth for that year, might be 25%. So if the market does, if the cap is 15%, if the market does 17%, they'll pay you just 15% growth. How about when the market drops? How about when it drops to like -30, -40, like -60, like it did in 2008? What is going to happen? They'll still pay you the floor of that account, the guaranteed. But if they guaranteed you 8.75, they'll still pay you that 8.75, even if the market is going -60. So annuities are a secured way of growing money in retirement to make sure that you do not run out of money. So if you had like a 401k plan and all of those in variable accounts, which are variable accounts, at a certain stage in life, it's advisable to roll that money into annuities where you will never lose a penny. Because at that point in life, a guaranteed income at retirement is more important than the growth. Because what comes with growth also, the potential for you to lose all of that money. So you want to move that money into annuities or assets that have a lower risk level. And annuities have a lower risk level. Annuities, you can do single premium annuities or you can do multiple premium annuities. Single premium or multiple premium annuities. Single premium is when you roll like a 401k plan, you bring in one lump sum, you create that annuity. Multiple premium is when you contract with the annuity company to be making periodic payments into the annuity. Periodic payments into the annuity. Might be every month, it might be every quarter, might be every year to create that annuity. Income payments. Income payments. There are two types of annuities here that are defined by how you create the annuity. Again, there's that are defined by how that annuity pays you, how income from that annuity is paid to you. And an annuity might be an immediate annuity. An immediate annuity meaning as you create that annuity within 1 year, they start making payments to you. That's an immediate annuity. Income payments start within 12 months from the date of.
I'm sorry, I have a question.
Which is, go ahead.
When you talked about the annuity, like making payment like a monthly payment, like how much do you think one can use to start that? Then when should someone expect return for the single monthly payment?
Well, it depends on how much you contract to have that money in that account. As you make those payments, it might be an 8-year annuity, it might be a 10-year annuity. So you put that money, you block it in that account. As you make payments, it grows, and maybe in 10 years, you start receiving income. So you say you might be 52 years old or 55, you block that money for 10 years, meaning you want to start receiving retirement income at 65.
Okay.
So at 65, they will start paying you a stream of income.
Okay. Okay. Thank you, sir.
You're welcome. Yeah. Again, you can stop me anytime. You can interrupt and ask me any question, and that's fine. Yeah. So an annuity where you want to start receiving payments 1 year and above, 1 year and above, that's called a deferred annuity. A deferred annuity. The annuity which I just showed you a few screens ago, that's a deferred annuity. That individual brought that money, created the annuity, and they want to start drawing money out of that annuity in 7 years. That's a deferred annuity, a deferred income stream annuity. We are almost done reading the material. At annuitization, and annuitization is usually referred to the period where you receive money from the annuity. It's called the annuitization period. And during that period, you can receive that money lump sum. So you can receive the entire growth after that 10 years or after that 5 years or after that 7 years, depending on how much time you contracted to block that money. Or you can, instead of receiving a lump sum, you can receive income stream. Remember that annuities, you can also have qualified annuities. They can be qualified or non-qualified. What is the difference? For a qualified annuity, you create that annuity from money that has not been taxed. Qualified just refers to the description or the qualification of that account by the IRS. Your 401k plan is an example of a qualified account, meaning the IRS approved that account to be created where they put retirement funds for you tax deferred, which means taxes have not been collected. 401k plan is a qualified account. So if they roll that money to create an annuity, that annuity is also a qualified account. When you want to create an annuity, when you talk to clients about creating an annuity, a question they are going to ask you is, if I roll my money to create an annuity, do I pay taxes on the money? And the question is no. You are rolling it from one qualified account, your 401k plan, to a qualified annuity account. So there are no tax consequences. No tax consequences from one qualified account to another. How about if you bring money, say, from your brokerage account, money that you had already paid taxes, you invested in the stock market, you grow it, and you're bringing that money to create an annuity? That is a non-qualified annuity. And you have to cash out those stocks to come create the annuity. So you're rolling money from a non-qualified account, you create a non-qualified annuity. Remember that for a qualified annuity, you pay taxes at distribution. Again, qualified annuity, like a 401k plan, when they start paying you that income stream, you pay taxes on the entire amount. For a non-qualified annuity, remember you had already paid taxes. So when you start taking money at distribution, you pay taxes only on the growth of that annuity. Only on the growth of that annuity. There are various payout options. Lump sum, you receive the entire amount. Life only, which is a straight life annuity, you get paid money every year of your life for the rest of your life. You know, that's a life only option or a pure life option. Refund life annuity, it says it guarantees you a certain amount for the life of the annuitant, but if there's a balance that has not been collected, they pay that money to the beneficiary, either in cash lump sum or in installments. Joint life annuity, there's a difference between joint life annuity and joint and survivor. Pay attention, you will see a question in the exam about this. Joint life annuity is an annuity that you create for two people, usually a husband and a wife. You create an annuity. For joint life, when the first person dies, they stop paying. Joint life. When the first person dies, they stop paying. Again, I said, you want to write something to remember joint life and joint and survivor, write joint life equals the first to die. They stop. How about joint and survivor? If that annuity was a joint and survivor, again, they'll be paying money to two people, usually a couple. When the first person dies, they still continue paying money to the second person or the survivor. It might just be a reduced amount. That's joint and survivor. Annuity setting is an annuity where they pay you a certain amount until that amount exhausts. Annuity setting. Okay. Annuity setting might involve what they call a fixed amount or a fixed period. Remember this, you'll see it in the exam. An annuity setting might involve a fixed amount or a fixed period. A fixed amount is when you, the person who is the annuitant or the person where money is going to be paid to, and this is probably decided by the owner who created that annuity at the time of creation, that is going to be a fixed amount. You choose how much you want to get paid a month or a year during the time of annuitization, during the time where you're getting paid income. You choose a fixed amount, and depending on how large that account is going to depend how long that annuity is going to last. So that's called fixed amount. You choose a certain amount. Fixed period, you choose a certain duration where you want or when you want that money paid. The fixed period might be 20 years, which means you're going to get paid for 20 years. If you choose fixed period, say like 20 years, then the annuity company is going to decide how much money you're going to get paid a month or a year based on the size of the annuity. So annuity setting is either fixed amount or fixed period. And these are all called settlement options. These are all called settlement or payout options. All right, let's do chapter quiz. I know we're starting the quiz a little bit late, but we'll go through the questions fast so that we can retire for the next day. Oluwatosin, are you there? You want to read this one?
Before he died, an annuitant had received $12,500 in monthly benefit from his $25,000 straight life annuity. He was also the insured under a $50,000 paid up whole life policy that named his wife as primary beneficiary. Considering both contracts, how much would the annuitant's spouse receive in benefits?
Okay.
B, $75,000. C, $62,500. D, $50,000.
All right. So let's reason it. Well, who can reason it out and tell us what the answer is?
$5,000. $25,000. Life annuity was also the insured under $50,000 life insurance that his wife as primary beneficiary. Considering good conformal with annuitant spouses, annuitant spouse receives the net benefits.
$62,500.
All right. So what was the answer?
I would say $62,500.
Okay, so let's try to it. The first part of that question says, before he died, an annuitant had received $12,500 in monthly benefits from his $25,000 straight life annuity. What type of annuity was that? Straight life annuity.
Straight life annuity.
What does a straight life annuity say? They pay you the money for your life while living. They will pay you funds for your life. The payment. You know, I received 12,500. Yeah, received 12,500. So, because it was a straight life annuity, after they die, the payment stopped. So, if let's say he lived past a certain year, they would have paid him more than the 25,000. Because they will continue to pay for the rest of your life. But he died when he had received just 12,500, so they stopped. So let's look at the second question, part of the question. It says, he was also the insured under a $50,000 paid up whole life policy that named his wife as the primary beneficiary. So there was an insured or an insurance for $50,000. Considering both contracts, how much will the annuitant spouse receive in benefits? What do we think is the answer now?
When he dies, the straight life annuity will stop. So they will not pay the spouse anything after.
Excellent. Very true.
The only thing the beneficiary is entitled to is the $50,000 that is.
Excellent. $50,000. And that's correct. Oluwatosin, you want to read that explanation?
The life policy will pay the face amount, but because of the settlement options related on the annuity, payments would cease upon the annuitant's death. Straight life annuity payments stop at death of the annuitant regardless of the principal left in the account.
Very true. Very true. Yvette, are you there? And if you're there, can you read this one for us?
Which of the following policies will be classified as a traditional level premium contract? A, straight life. B, variable universal life. C, adjustable life. And D, universal life.
Okay. Traditional level premium policy. Traditional level premium policy. It's an interesting question. It's an interesting question. Let's do elimination here. First of all, a universal life policy is a flexible premium policy. A universal life is a flexible premium policy. But here, they're talking about a level premium policy. Traditional level premium policy. Variable policy, I don't know if they'll call it a traditional level premium policy. Adjustable life means things can change. They can adjust the face amount, they can adjust the premium, but they're talking about level premium policy. So we eliminate C, we eliminate D. It's between B and A. We'll find out. And that's correct. Straight whole life policies have a level guaranteed face amount and a level premium for the life of the insured. straight life, for the life of the insured. All right, let's do number 3. Lola, you want to read this one for us?
You remembered me now. You didn't think that.
My
Which of the no, is not extend for the period of time during which the annuitant or the beneficiary receives income. A, depreciation period.
Yes, go ahead.
D, payout period. Depreciation does not sound right.
Okay. So they say, which of the following is not a term for the period of time during which the annuitant or the beneficiary receives income? You're correct. Depreciation period is not an option. So submit the answer, and that's correct. Just the annuitization period is the time during which accumulated money is converted into an income stream. It is also referred to as the annuity, liquidation, or payout period. So the annuitization period is the time during which accumulated money is converted into an income stream. So remember that there are chances you'll see that in an exam. I'm going to go a little faster because it's getting late and it's a Sunday night. Florence, you want to read this one for us?
All of the following are true about variable product, except A, the premium are invested in the insured general account. B, the minimum death benefit is guaranteed. C, policy owners bear the investment risk. D, the cash value is not guaranteed.
Okay. All of the following are true about variable products, except based on what we explained. Who can tell what the answer is? Let's start with D. Let's learn by going through the options.
The cash value is guaranteed. Yes, it's true.
The cash value is not guaranteed. Is that true?
It's not guaranteed.
Correct.
Yes.
Policy investment risk for variable products. Is that true? Policy owners bear the investment risk for variable products. Remember, variable products, they choose to put their money in the variable market, in stocks and all of that. They bear the risk of the investment.
The risk.
I think
Policy owner release.
this should be the answer.
Pardon?
I'm thinking it should be the answer. The premiums are invested in the insurance general account.
In our lectures, where do we say the premiums are invested?
General account of the
because it's variable, the premiums are invested in the separate account, not the general account. So except, that is the except. But let's look at B. B says the minimum death benefit is guaranteed. Remember that for variable products, the minimum death benefit is guaranteed, because for a variable product, part of the premium goes to pay for a death benefit, and that minimum death benefit that part of that premium is going to pay for is guaranteed. What is not guaranteed is the amount that they're going to generate from the variable portion, because it fluctuates. It's not. So the exception is A, the premiums are invested in the insurance account, which is true. Let's find out if we're right. And that's correct. Insurers selling variable products invest their customers' monies in a separate account, which is very similar to a mutual fund. Since there is no guaranteed rate of return, customers must bear the investment risk. We're learning. Yvette, you want to read this one for us?
What is the purpose of establishing the target premium of a universal life policy? A, to cover all policy expenses. B, to accumulate cash value faster. C, to keep the policy in force. D, to pay off the policy faster.
Okay. So remember, I ran this illustration about a universal life policy, okay? Right here. And when I ran this illustration, you saw how it's growing policy value. This is the column for policy value. It's growing policy value right here, and it's growing cash value right here. And when you pay the target premium for the policy, it's intended to grow your policy value, that if you miss a payment, they'll take it from your policy value and pay your premiums. Let's go back to the question. So what is the purpose of establishing the target premium for universal life policy? Based on that explanation, the answer is C.
It will keep the policy in force.
C. Remember that. Let's see if we are right. And that's correct.
The target premium is a recommended amount that should be paid on a policy in order to cover the cost of insurance protection and to keep the policy in force throughout its lifetime.
Correct. Correct. Let's go to the next one. Oluwatosin, you want to read this one for us?
Which of the following best defines target premium in a universal life policy? The maximum amount the policyholder may pay on a policy, the corridor of insurance, the recommended amount to keep the policy in force throughout its lifetime, the minimum amount to make sure the policy is annually renewable.
Okay.
The recommended amount to keep the policy in force throughout its lifetime. That's the explanation we read to.
Explanation I made on the previous question, just bring all of those explanations here, and Oluwatosin is right. It's C. So.
In force throughout its lifetime.
Right.
The target premium is the recommended amount that should be paid on a policy in order to cover the cost of insurance protection and to keep the policy in force throughout its lifetime.
Very true. Very true. Next question. Lola, you want to read this one for us?
Okay. Which of the following is incorrect regarding a $100,000 20-year level term policy? A, at the end of 20 years, the policy cash value will equal $100,000. B, if the insured dies before the policy expired, the beneficiary will receive $100,000. Okay. C, the policy premiums will remain level for 20 years. D, the policy will expire at the end of 20-year period.
Okay. What is the answer here?
Which of the following is incorrect?
It's a level term policy. It's a level term policy. When we see term, there are two things we should outrightly conclude. The term policies, you're right. It will expire within a certain duration of time. Very true. It lasts only for a certain duration and it will expire.
Yeah.
Does it accumulate cash?
No.
No.
Okay. So based on that, what is the answer?
If the insured die before the policy expired, the beneficiary will receive
Remain the same.
100,000.
Okay, we see.
At the end of 20 years, the policy can value equal 100,000.
Correct.
Which of
Correct.
incorrect?
It does not have cash value, so A should be. If
What
insured
answer?
is A.
Correct. The answer is A. At the end of 20 years, the policy's cash value will equal 100,000. Term does not cash.
No accumulates cash value.
There you go. You have to read the questions clearly and the answer will be right there. The answer is always in the question. Always. So say 10 policies do not develop cash values. All the other statements are true. Okay. Next.
What does level refer to in level term insurance? A, cash value. B, interest rate. C, face amount. D, premium.
Okay. There are two here that we eliminate, and then we can tussle between what is left.
Cash value.
We kick out cash value, true. Which other answer do we kick out?
Interest rate.
We kick out interest rate, that's true. So we are not left with face amount
And some premium.
and premium.
I think it's D.
Okay.
Premium.
You think it's D, level refers to the premium?
Yes.
Whenever I come to this question, I can not decide between face amount and premium. Never. But you say premium, let's go with that. See?
D, face amount.
I can never decide.
So it's face amount.
Term has a level premium and a level death benefit. So I don't know where they get their conclusion to say level refers to the premium. Yeah.
So what's the answer?
Face amount.
Face amount.
Face amount.
Correct. So you just have to cram me that is face amount.
Face amount referred to as level premium. Okay.
So level policy and level death benefit out the term of the policy. Insurance, the premium also remains consistent over the year. So they just told us that is level also.
Change.
Policies which increase in the policy policy owner's older age. So you can see level is also, they say the premium also stays consistent, which means it's level.
It doesn't change.
Level is face amount and level is premium. You just have to cram the fact
that level is face amount
referring to the face amount. Yep. So let's go to the next one. Florence, you want to read this one for us?
It is a domestic insurer issuing variable contract must establish one or more A, annuity account, B, separate account, C, liability account, D, general account.
Okay.
I think annuity account.
Pardon?
Domestic. I was looking at annuity account. I'm not sure.
But they say a domestic insurer issuing variable contracts must establish. Let's try to see what they're asking in the question. They are asking about that domestic insurer establishing either one or more of something. Remember, when we talked about the number of accounts, we talked about if that client is going to be a client with a variable contract or if that client is going to be a client with a fixed or fixed index contract. So when we're talking about if it's going to be variable or fixed, then we're talking about if those accounts are going to be separate accounts or
It's B.
in the company's general account. If it's variable, then put that money in the company's, in the client's separate account, because the choices of that client is going to depend the fluctuations of growth. If it's a fixed annuity or a fixed index annuity, they're going to put that money in the company's general account. A domestic insurer issuing variable contracts. So what's the answer?
B.
Correct.
Separate account.
Separate accounts, because there are going to be many clients who have variable contracts, and they're going to have to put their monies in their own separate accounts.
So what did you say domestic insurers are?
The domestic insurer, they just mean an insurer operating in the state in which it was incorporated. They just put that word domestic to throw us off.
The controls, okay.
It might be a domestic foreign insurer. A foreign insurer is an insurer operating in a state other than the state that it was incorporated in. For example, if a company is registered, say, in the state of Iowa and is doing business in Minnesota, that's referred to as a foreign insurer. If that client was incorporated in the state of Iowa and is doing business in the state of Iowa, then it's a domestic insurer. If that was incorporated, say, in a foreign country, say like Switzerland or Canada, and is doing business in the United States, what is it called?
Alien.
An alien insurer.
Yeah. Okay.
Domestic, there's foreign, there's alien. So they just put that word domestic here to throw us off. It has nothing to do with if it's domestic, foreign, or alien. They'll still have to put that money in separate accounts. All right, let's see if we are right. And that's correct. They say any domestic insurer issuing variable contracts must establish one or more separate accounts. The insurer must maintain in each separate account assets with a value at least equal to the reserves and other contract liabilities connected to the account. Usually they say they want that account, that insurer, to have at least $2.5 million of assets. You might see that in the exam. Remember that word, $2.5 million of assets. All right, just 5 more left and we're done. Oluwatosin, you want to read this one?
All of the following statements about equity index annuities are correct, except the interest rate is tied to an index such as the Standard or Poor's 500. B. The annuitant receive a fixed amount of return. C. They have a guaranteed minimum interest rate. D. They invest on a more aggressive basis and aiming for higher returns.
All right, so this question, let's do elimination first, okay? There are 2 that we can eliminate. They say all of the following statements about equity index annuities are correct, except look at A. A says the interest rate is tied to an index such as the S&P 500, the Standard and Poor's. Is that correct? That is correct. Remember what we said is that with an equity index annuity or a fixed index annuity and equity index annuity are one and the same thing. So with an equity index annuity or fixed interest annuity, with an equity index annuity, what happens is that they put your money in a fund, they tie it to one of the indices on Wall Street, NASDAQ, S&P 500, Global Account, Balance on Cap, Dow Jones, and the growth of that account depends or is responsible for the growth of your fund. So again, you're pegged to that index or that equity index. When the S&P say grows by 10%, you're gonna get 10%. So the question says the interest rate is tied to an index such as the Standard & Poor's, which is true. So we eliminate that one because they say, which of the following statements about equity index? They say all of the following statements about equity index annuities are correct, except, so 3 are correct and 1 is wrong. We already eliminate A because it's correct. Let's go to, he says they have a guaranteed minimum interest rate. Is that true? And the answer is yes. Equity index annuities have a guaranteed minimum interest. I say your minimum interest is 7.25, that's the minimum that is guaranteed. But because it's an equity index, that word index, is if the market is performing higher, you can also receive higher returns up to a certain cap. So they have a guaranteed minimum interest rate. That is true. Your account can never go below that minimum. So we eliminate A, we eliminate C, we are left with B and D. Now, this is where it gets a little dicey. Because B says the annuitant receives a fixed amount of return. And D says they invest on a more aggressive basis, aiming for higher returns. Which one do we think is the answer?
B.
Pardon?
B.
B.
All right, let's try and see if that's correct. And that's correct. Except because equity index can receive more than the fixed, because the fixed is guaranteed, but if the market does better, it can receive better. Which also means D is right. Or the content of D is correct in the sense that they invest on a more aggressive basis, aiming for higher returns. Because if the market performs better, then that index fund also grows better. It also grows by a higher interest rate. I'm going to pause this video, listen to it, the logic carefully, and you will not miss this question in the exam. So equity index annuities have a guaranteed minimum interest rate. So while they are aggressive in nature, the annuitant will not have to worry about receiving less than what the minimum interest rate would yield. So 4 more to go and we're done. 4 more to go and we're done. Lola, you want to read this one?
What are the 2 components of a universal policy? A, insurance and investment. B, insurance and cash account. C, mortality cost and interest. D, separate account and policy loans.
Yes.
Insurance and cash account.
Excellent.
Insurance and cash account.
Yeah. Correct.
What's that password with cash?
Yeah. Again, we go back to this illustration. It started with a $2 million policy. We see the cash account here, and the policy value is creating. That is determining the death benefit. So the insurance, which is the basic 2 million, plus the cash account, which is 344,774, the death benefit is 2344774. Go to our equation, insurance and cash account, correct. Says a universal policy has two components, an insurance component and a cash account. The insurance component of a universal life policy is always an annual renewable term. Remember that. A universal life policy is an annually renewable term policy and a cash account. The cash account accumulates on a tax-deferred basis each year and earns either the guaranteed contract rate or the current rate, whichever is higher. Remember, it's an index account, so there's a guaranteed minimum. And that's why we tell our clients, you'll never lose money because there's a guaranteed minimum. Okay. Next question. When you're doing your laundry, when you're cooking, when you're doing, just play this. These videos are all, you guys are all going to have the links. Just listen to the videos and these explanations will sync. Yeah. Oluwatosin, you want to read this one?
Which statement is not true regarding a straight life policy? The face value of the policy is paid to the insured at age 100. Its premium steadily decreases over time in response to its growing cash value. It usually develops cash value by the end of the third policy year. It has the lowest annual premium of the three types of whole life policies.
Okay. Let me just give you guys a hint. When you see the word straight life policy, it's a form of a whole life policy. When you see straight life policy associated with whole life, it's a type of whole life. So based on that hint, what do you guys think the answer is?
C.
And let me give you another hint with whole life. Another hint with whole life. A whole life policy is a level premium policy. Whole life policy is a level premium policy.
So that will make it B.
B.
It's true.
But the fair is not.
But again,
It's not.
let's read that we know some of the characteristics of a whole life policy. The face value of the policy is paid to the insured at age 100, which is true. Life policies mature at age 100. Look at C. It usually develops
policy.
Yeah, it's not true.
So C, and let me show you guys something. Though this is in a universal life, whole life, universal life is a form of whole life, but kind of much advanced. By the end of the third year, see here, is developing cash value, which is true. Let's go back to the question. It has the lowest annual premium of the three types of whole life policies. For a straight life policy, that's true. Like you guys rightly said.
Is B. Decrease, causing decrease.
And that's correct. Oluwatosin, you want to read the explanation below?
Life policies charge a level annual premium throughout the first lifetime and provide a level guaranteed death benefit.
Correct. Straight life policies charge a level annual premium throughout the insured's lifetime and provide a level guaranteed death benefit. Very true. All right, two more to go.
Variable whole life insurance is based on what type of premium? A, graded. B, increasing. C, level fixed. D, flexible.
Okay.
So level is fixed.
Level fixed.
All right.
C.
Very smart, very intelligent. And that's correct.
Variable whole life insurance is a level fixed premium investment based product.
Correct. Very true. Number 14 here. Lola, you want to read this one?
Which two terms are associated directly with the way an annuity is funded? Increasing or decreasing? Single payment or periodic payment? Immediate or deferred? D, renewable or convertible? I think it's C, immediate or deferred.
Single payment or period.
B, single payment or periodic payment is being funded,
Yeah.
not paid.
Yeah. It's about how payments come out of the annuity.
Is B.
B is about how it's funded. Premium periodic payments. Let's see if we are right. And that's correct. You see, annuities are characterized by how they can be paid for, either a single premium lump sum or periodic payments in which the premiums are paid in installments over a period of time. Periodic payment annuities can be either level, in which the annuitant owner pays a fixed installment, or the payments can be flexible, in which the amount and the frequency of each installment varies. You guys are doing great. Last question here. Last question. Let's have Oluwatosin conclude this one.
Which of the following cases will the insured be able to receive the full face amount from a whole life policy at age 65 if there are no named beneficiaries when the policy is paid up, as soon as the cash value exceeds the face amount, if the insured lives to age 100?
Okay. Okay. In which of the following cases will the insured be able to receive the full face value amount from a whole life policy? We said a whole life policy matures at what age?
100.
Okay. So what's the answer?
Just leave to age 100.
I heard somebody said D. Let's see if that's correct. That's very correct. Yvette, you said D. You want to read the explanation?
Whole life insurance provides protection for the entire lifetime of the insured. If the insured lives to the age of 100, the company pays the face amount of the policy to the policy owner, usually the insured.
Excellent. So we've answered all the questions. Let's submit and see how we did. 93%. We missed just one. So great job, class. Keep studying. Like I would always say, you guys are more ready than you think. These videos are going to be, I'm sending updated links. Yvette, text me your number. Let me give you my phone number. You text me your number so that I can forward the links to you, because I know you're not in that forum. So do you have a pen?
Yes.
Text your number to 816-914-9632.
816-914-9632.
32.
32. Okay.
I'll send the links to you in the licensing forum that Mark Ode created. Florence, you're not in that forum, so send me your number also, or text me your number. Again, my number.
Should I use the group to do it now? The text chat group.
Which text chat group?
Should I text it here now?
Yeah, you can text it here now. Yes. No. Send it to my text, because when I end this meeting, I've lost it. If I don't write it, then I'm gonna be like, so send it to my WhatsApp at 816.
Hold on. Hold on, I have to write it down. It's